morning. My name's Ed Stone. I'm the long-term care specialist here at First American Insurance Underwriters. We appreciate folks in this short holiday week taking some time to jump onto our series for long-term care, extended care planning. This has been a series of 4 different meetings that we've had. This is our 4th meeting. They will all be archived, and we'll be getting links out to you so that you can listen to them anytime when you're bored, in the middle of the night when you got nothing better to do. Jump on and relive all the things we talked about. We talked first in the first session, for those that you hadn't joined us, we had a conversation about the tools that we have here at First American to help you market. Our second call was a call with underwriters to talk about how to do effective field underwriting to get more cases through. We also had a visit on one of our calls with Carol Golden, the executive director of the NAIFA Extended Care Planning Center, where we talked a lot about the issues surrounding our industry nationwide. And it's my pleasure this morning to bring my cleanup hitter, Kevin Fisher, as regional sales director with OneAmerica. OneAmerica is a fantastic company based in Indianapolis, Indiana, where I'm from, born and raised Hoosier. So we're real happy to have one of my hometown companies here. Kevin, thanks a lot for joining us this morning.
I appreciate you taking time for me.
Absolutely. I just wanted to start off with a lot of folks aren't aware of OneAmerica. You don't do the flashy Super Bowl advertising and stuff like that outside of Indianapolis. Sometimes you aren't known. Give us a little background on who OneAmerica is and what your role is with them. Okay.
Well, I've been with OneAmerica. This is my 11th year. I'm not technically 10 and a half years with the company. Yesterday. Anyway. Long and short of it is we are a mutual carrier based in Indianapolis, as Ed mentioned. We are an innovator of the asset-based long-term care space. 30-something years ago, that space was created by 2 companies, First Penn Pacific and the Golden Rule Company. First Penn turned into Lincoln and MoneyGuard. Golden Rule turned into OneAmerica and Asset Care. So we've got a little bit of a legacy inside of the asset-based long-term care solutions. And remember, when we call it asset-based long-term care, it's also called hybrid or linked benefit. Right. There's no really one settled upon set of language that we want to use what we want to use, we use, but there's no settled on definitive language as to describe what we do. So we at OneAmerica, we are a mutual carrier. We've been doing asset-based long-term care since we created that segment. We offer products that are quite unique in the industry. We've seen the industry grow from the 2 originating carriers to dozens today. And I don't consider or include in that statement of dozen carrier chronic illness riders. That's life insurance with a living benefit access point, but it's not long-term care. That's something that we have to really, really, as planners, focus on, because a lot of people have mischaracterized that. Right. And created issues.
Well, we're going to jump into that. So since you brought it up, let's jump into it right now. A lot of the advisors, as you said, run out and just sell, life insurance. I'm going to throw some chronic illness on there, and you got your long-term care covered, Kevin. What are you seeing the mistakes of advisors doing that?
A couple of things. And now, first off, using a chronic illness rider, it will vary considerably from carrier to carrier. I mean, there's no uniformity in it at all. Generally speaking, the qualifying criteria is really limited in scale. Generally, cognitive impairments are not a trigger, whereas a long-term care policy, either a cognitive impairment or inability to perform 2 out of the 6 activities of daily living are triggers. Along with that, in some products from a chronic illness perspective do allow for this, few and far between. But the second part is, from a benefits perspective, oftentimes chronic illness riders are limited to facility-based care. Right. With long-term care, true long-term care products, it's either at home or in a facility. And what we like to say is our objective using long-term care planning and including an insurance policy in the equation is that we can keep you where you want to be receiving care at home for as long as you can be receiving care at home safely. Our objective is to keep people where they want to be, not put them where they really don't want to be, which is a facility. So that's really the primary differentiators between that. Now, the second component of this, and it actually goes to long-term care riders as well, they're bolted onto the back as a rider of a life insurance policy. Why are you buying life insurance? Because you have a life insurance need. If you have let's just call it a chronic illness claim, and you end up pulling out $350,000 of death benefit, and now your death benefit goes from $1 million to $650,000. Did you destabilize your plan for that $1 million death benefit? If the answer is yes, then the chronic illness rider may not be the best primary idea. It's a good backup plan, but it shouldn't be your primary consideration. If you want to manage around that, you can do one of two things: buy a long-term care policy or increase your death benefit so that you have a little bit more buffer inside of that. Which is right? Hey, it's whatever's right for you and the client philosophically. So there are distinct advantages and disadvantages. I think the biggest thing that we've done as an industry, and I've been in the industry since I had hair. The big thing is we've gotten, I'm going to call it lazy, but I don't mean it in a malicious way, but we've gotten lazy in that we find the easiest solution for problems that really exist by avoiding underwriting. And long-term care is really, it's a touchy-feely and it involves a little bit of underwriting. The one advantage that we have at OneAmerica relative to our peers is we're willing to underwrite. We'll do an informal. We encourage informals. We'll table rate, out 8 tables with our asset care life-based policy. And if we can't get it done, we can always pivot into our annuity-based policy. So we're not afraid to underwrite. And that's really, to me, an important factor. And remember, with a lot of chronic illness riders, when you pop them on the policy, your client still has health limitations. Some products won't allow you to put anything on someone rated more than table 4. So there's a lot of stuff going on there. And again, I'm not saying they're bad. I'm just saying you have to know what you're selling and know what you're placing and the objective you're trying to accomplish.
I think the other part of the area where agents and advisors aren't really paying enough attention to is at the back end on the claims side with some of those products. If they're not charging for the rider, at some point in time, the company's gonna have to make up something. Whereas a linked benefit, asset-based hybrid product like we're talking about with OneAmerica and the other carriers that we use, your client knows from day one what they're going to get. And
exactly.
To me, that's a vitally important difference between doing what you're talking about and what a lot of advisors have, lazy is not the wrong word, have just gotten complacent, take the path of least resistance and go that way. So why are you seeing such a large increase in the attractiveness or the sale of linked type of products as opposed to way back when I had hair starting in the traditional part of the industry? It was 95% traditional, 5% linked benefit. It's totally flipped over. Why are you seeing that?
I think there are a couple of reasons. One is really the nature of the products, the nature being the pricing structure. In that a linked benefit asset-based hybrid, what you see is what you get, both benefits and premiums, and they're guaranteed. So you take that moving part out. With a traditional product, historically, there was a mispricing issue, and it kind of sort of destabilized things and made a lot of people unhappy. And you consistently see every 6 months or more, frequently, depending on what state you're in, requests by carriers to increase their the premium for the existing block of business. Now, that being said, we're talking about non-can long-term care from an asset-based product versus guaranteed renewable. That's a very important element to keep in mind, especially if you're funding on a recurring premium. Single premium, who the heck cares? Short duration premium, pretty much the same thing. Who the heck cares? You can be done in 5 years. But if you're funding out to age 95, 100, et cetera, that's an important component. The second element, which is I think where all the value comes into this, is one way or another, the client's family is going to receive benefit from the policy. If you live and you need long-term care benefits, you got it. If you never use that, your walkaway provision is going to be the death benefit. In the case of the life insurance policy, it's a life insurance death benefit. In the case of a deferred annuity, it's going to be the annuity account value. One way or another, there's going to be benefit coming out of that to that family. And remember, you're selling long-term care insurance. Sure, you're insuring that person, but it's really for the benefit of the family so that they can retain their standard of living and be able to do everything that they are currently doing without making significant sacrifice in giving up careers or compromising in that fashion. So those are the two real value drivers from an asset-based perspective. Here at One America, from our perspective, we have a couple of different things inside of there that are driving. In addition to that, one is we offer the only true joint policy for both husband and wife on both a life and annuity chassis. We also offer the only lifetime benefits. And for someone that's concerned about longevity or has a family history and concern and experience with a cognitive impairment, those are very big drivers. And then, and the third thing where we've seen a lot of action, in addition to our recurring premiums stepping up because of the guarantees, is our turnkey qualified money solution, where we do the IRA rollover and we fund the policy being asset care using those qualified dollars. So we've seen a lot of movement, both from the industry perspective and then in the unique pieces from One America.
Now, in fairness, since we do both here, for those that are listening, one of the things that I try to preach here at the firm is bring us the case. We're going to find the right solution. In some cases, a traditional policy, and we can obviously have a long conversation about the mistakes. I worked for the carriers when we made the mistakes about the pricing. In some cases, a traditional plan is going to be the solution, maybe a budget purpose type of situation, underwriting, et cetera. So when you bring us a case at First American, we're going to analyze it from all filters. And if it is something where traditional makes the sense, will make the most sense, we will tell you why and talk about those issues about past rate increases, et cetera. But in many cases, the linked asset-based hybrid products make a lot of sense. So that's why we're having this session today, to kind of do some comparison and contrasting.
Right. We don't want to be everything to everybody. We want to be the right thing for the right client. And working with FAIU is the right way to go at it, because like Ed said, depending on the nature of your case and your unique circumstances, you can build the right solution. And that really, to me, is a very valuable approach. And I would rather do the right thing and lose the business than do the wrong thing and get business. I never have to apologize for doing the right thing.
You did mention unlimited benefits, and I get this question all the time. Well, why does somebody need unlimited benefits, Ed? That seems like overkill. You guys have a really unique perspective on that, about the idea of how many people need care versus how many you can predict, et cetera. Could you just review that real briefly for everyone?
Well, it's really pretty simple. And I go off script on this one, and the whole objective for unlimited lifetime benefits, and from my eyes, is simply this. If my wife and I are joint insureds on a policy, I cannot possibly screw up our plan by getting sick or hurt or having a cognitive impairment that lasts a very long duration of time. I cannot gut our policy. So if I'm receiving $10,000 a year and I only last 2 years, that's great. It's still inside of the averages. But if I have a cognitive impairment and I live 10 years, first thing I do is I've blown through the average. Then I've blown through the average times 2, and now I've run out of a policy because of limited duration policy. You're capped at whatever that pool amount is. With an unlimited duration, I can keep on going. Second part is, if I'm on claim, and here's the value to it, and my wife has a similar scenario where she needs services, she can also be receiving benefits at the maximum monthly allowed for whatever duration of period of time it may be. So if I'm receiving 10,000 a month, she can receive 10,000 a month for infinity. So that's really the value, is our never-ending pool. Now, why would we consider that when only 20% of the people have claims over 6 or 8 years? Why not? Do you know who that person is going to be? And the answer is no. I mean, you've got some markers that might help you down that road. You know, those markers being family history of longevity or cognitive impairment, or, you know, and there are changes being made so often and frequently as it relates to cognitive impairments in research and studies. That's a big thing. Interesting thing earlier this week, Chris Helmsworth, who was Thor, he stepped away from acting because he has genetic markers consistent with that of Alzheimer's. And he wanted to maximize his time with his family and kids. 3 weeks ago, we wouldn't have that story. 3 days ago, we got that story. So with all these trends and lining that up with planning, you can kind of sort of hedge your bet. And would you rather be wrong and have a plan in place if something were to happen, or be wrong and have no plan in place and end up really destabilizing your whole strategy for retirement? And it's not just you, it's reaching out and touching others. So I would rather be wrong and have a plan in place. At least then we know how to execute.
But we're seeing more and more from the claim standpoint that it's not Betty's broken hip, it's Betty's broken brain. And
Exactly.
That's the one that, just for those of you that are listening now and listening to this in the future, that's where I'm seeing the underwriters being so concerned and the actuaries being so concerned, because according to the Alzheimer's Association, average cognitive claim is going to be 8 years or longer. And if you live long enough, there's a good chance something's going to happen, and the doctors aren't letting us die. So there's a good chance cognitive issues are going to be more and more. So the case for unlimited makes a lot of sense. So that's why I wanted to have you on, particularly because in the linked space, you're the only carrier that does do unlimited. We have a carrier in the traditional space that does unlimited. So we've got a couple of options there. Tell me about the qualified plans again. You mentioned that earlier. To me, that is such a wide open market today, and you guys have a great program in it. Speak a little bit more about how that works.
So funding a policy using qualified money is really, it's not a unique concept. It's just the way in which we've created it. You can do it on your own by managing and just directing those funds. But what we've done is we've created a turnkey solution. We did this 20 years ago, and it's still working today. The only difference between then and now is the asset care product today is a better product from a pricing perspective, and the operation between the two of them. Here's an opportunity, by the way, for inherited IRAs and inherited qualified money because of the Secure Act. Secure Act, we have to liquidate in 10 years. So let's use this as an example. I'm 59 and a half. My mom and dad are in their 80s. They pass, I inherit their IRA. And my question is, what do I do with it? Well, the Secure Act says I have to liquidate in 10 years. Now, even if this is my own money, the Secure Act doesn't really come into play, but it is the same strategy. So I take that IRA money, I roll it over into One America. And what we do is we set up a qualified deferred annuity. That qualified deferred annuity is going to be our funding mechanism for our asset care policy. How we design the asset care policy, we can be limited in duration, we can be unlimited in duration. We can accelerate quickly and get a big fat long-term care benefit, or we can be long and lean and have a smaller one. It all comes down to the specifics of that particular case. But the fundamental is we're using an IRA rollover into our qualified deferred annuity as a funding vehicle. So that money comes in to the deferred annuity. We automatically give it a 20% bonus. So we turn a $200,000 into $240,000. Then over a period of 10 years, we distribute and fund our asset care policy. That distribution is what lines up with the whole Secure Act piece. Now, the second point I want to make here, I think, is the most important one. Our distributions are not because we're annuitizing. If we were to annuitize, that kind of binds our hands if your client's older, over 72, and taking those distributions. If they're over 72 and they take those distributions to fund their asset care, from this strategy, those can count toward required minimum distributions. If it was a SPIA, those monies being distributed would not count toward required minimum distributions. So the strategy in and of itself helps you get down that road. So what we do, those 10 years of distributions, in this case, let's just say it's 24,000 a year. That distribution is constructive receipt. We create a 1099 and we utilize that to fund our asset care policy. Plain and simple, done after 10 years. If the client goes on claim, say in mid-year in year 5, we would do a waiver of premium and we'd ask 2 questions. 1, how do we get the claim going for you? And 2, how do you want your money for your premium this year? Because, we have no policy to pay it in and we're waiving the premium. Remember, this is the constructive receipt allows me to determine how I'm going to design my policy, being the asset care. So it can be either an individual for me or a joint policy for me and my wife. So that means my IRA money is paying our long-term care benefit, and you still have the same provisions inside of there that are relevant to all of our asset-based products. If you live and you need long-term care starting day 1, you have tax-free benefits for the duration of that need. If you die somewhere along the way, the benefits that aren't utilized will be paid tax-free. If it's a joint policy, it'll be on the second death. And if you want to walk away, you can walk away with some of the money, or all of the money, or more than what you put in. It all is point in time and funding. So one way, shape, or form, you are made whole, and you have a strategy that is really turnkey, and you don't have to manage it. You can do a similar thing if you self-direct the funds. You can do a similar thing if you use a SPIA, or if you have a fixed annuity and you want to turn on an income rider. But just understand, you may have limitations and limits as it relates to deductibility and meeting things from an RMD perspective. What's right? It's really what's right for your client. How much control.
What's really important, I think, in what you said, Kevin, is a lot of times advisors call up or come to me and say, I've got these 2 clients, and the one has this huge 401k that we're going to, we want to pay for his or her policy out of. The other one doesn't have as big a one. So we simply say, fine, let's get all the money from that one, move it over, because now you can have both of them on the policy. Yeah, they're going to have to pay Uncle Sam. He can't beat the tax man, but it's going to really be a way for you to find the money. Find the money. That's what everybody says. How do we pay for this? They like the idea, but my goodness, where are they going to get the money? This, to me, is such an untapped market. The non-spousal inherited IRA is a great opportunity. I hadn't even thought of that one under the Secure Act. But just your regular, John and Mary situation, that's where you find the money, folks that are listening to this. That's where you can go to say, this isn't out-of-pocket money. Well, that's going to cut down my retirement. No, it's going to protect your retirement, because if you don't have it, the money that you got that's coming out of your retirement is going to have to pay for the care. Take a little bit off the top to save the vast majority of your 401k money down the line. So, and as you said, if I'm correct, as you said, you can certainly, go out and buy a SPIA and, use the money. But what I've always found is if you set up that scenario and the check comes in each year from that SPIA and it happens to be bass boat sale time, that's when that money suddenly doesn't go to the long-term care insurance policy and gets paid to the, for the bass boat or whatever. And to me, the fact that the client never gets their hands on the money, you guys have just a very simple system where it goes from one side of the building to the other side of the building, so to speak, and then they get the 1099-R. So folks, that's one unique thing that I think if you can take away from today, there's trillions and trillions of dollars sitting in these 401ks out there. for your 55 and 60-year-old clients who could get this all paid up on a 10 pay. So it's really fantastic. You know, we're coming up on the end of our time, Kevin. Is there anything else that I haven't covered that you think is of importance? Please throw it out there.
I have two things. And if I only get to one, that's fine. Two things that really will help you the most, and you probably have heard this over and over, and it's being repeated, but do a little bit of underwriting when you're meeting with your client. And you don't have to go down the underwriting questions, but just be observant and look at the risk. I mean, if they are utilizing a cane, or have oxygen, or have difficulty getting around, or it appears that they're disengaged with a conversation, that might be an indicator that there's something going on. So do a little bit of, remember to put that detective hat on and do a little bit of investigation in that regard. It will really, truly save you a lot of time. The second piece is, don't be afraid to ask for information and get an informal being, our underwriter will look at it and say, hey, yay or nay. Most important thing that you can get there are three things: the age of the client, the gender of the client, because we're not going to know on the sheet, and most importantly, their medications, because a lot of times the medication will be a pointer to something that they don't tell you medically,
right, that
they're experiencing. So those three things there. And one thing I want to say about underwriting, we are very aggressive at One America, and our underwriters want to try to find a solution, which is why we go out 8 tables. We will do an informal and spin it around within 24 hours. And right now our service time is 2 hours. And that's being conservative.
It's been lately about 15 to 20 minutes, to be quite honest.
Yeah. So we're pretty quick at getting that around. And remember, the most important thing is working with FAIU, you have the ability to find the best solution from a product perspective. And that's really what we're trying to do. I will give away business because it's the right thing to do. I don't want the wrong business. Absolutely not. And working with Ed and at FAIU, you're good to go in terms of finding the best solution. So that being said, I try to tap out before I get too long-winded.
Okay.
Just remember, there's a solution for non-qualified deferred annuities. And if you want more on that, give Ed a call.
Yeah. And folks, we do have our LTC Risk Finder tool that I send out with every quote so that we can get back the information. I send it to Kevin's team. If it's a slow day, it's going to be 15, 20 minutes. Sometimes before I even turn to the next project, I'm getting a response back from First America, from One America, and of course the other carriers, because I've got to show everybody all the different opportunities. Kevin, I appreciate you taking time out this holiday week to join us. And those of you that were on the call, thank you very much. We'll be getting the link out to everybody on this. And in closing, thank you for your business. We greatly appreciate the First American, and have a great end of the year, everybody. Take care. Bye now.
Thank you, everyone.